Good morning. Whether you're just waking up, scrolling through your phone, or catching the latest headlines, there's one topic that keeps popping up everywhere. Lately, something else is on everyone's mind: the price of oil. It's not just a headline, it's a conversation starter at work, at home, and even among friends grabbing coffee. You might notice it most when you fill up your car at the gas station, watching the numbers tick up as you pump. That number on the pump seems to be climbing higher and higher, sometimes changing from one day to the next. The price of oil touches almost every part of our lives, even if we don't always realize it. It's not just about what we pay at the pump. Oil affects the cost of shipping goods across oceans, the price of plane tickets for your next trip, and even the cost of food on grocery store shelves, since transporting those goods relies on fuel. So when oil prices go up, we all feel the pinch in our wallets. It can mean higher bills at the grocery store, more expensive commutes, and less money left over for other things. Right now, we are seeing a significant jump in these prices, and it's making waves not just in the markets but in everyday life. People everywhere are asking why this is happening and what it means for their family budgets, their plans, and their future expenses. The reasons are complex, involving a mix of global events, political decisions, and economic shifts that all play a role in shaping oil prices. Understanding these factors can help us make sense of the changes we are seeing and prepare for what might come next. The world's energy market is like a giant, intricate web, with every country and company connected in some way. A pull on one string in one corner of the globe can send vibrations all the way across to the other side, affecting prices and supply everywhere. This week, several strings have been pulled at once, creating a ripple effect that's being felt worldwide. We are seeing new risks to the supply of oil coming from Russia, a major global producer, as geopolitical tensions and sanctions disrupt the usual flow. At the same time, the amount of oil we have stored here in the United States has been shrinking, making us more vulnerable to sudden changes in supply. These two events alone are enough to make prices move, but when combined, they create even more uncertainty and volatility. Our goal is to give you a clear understanding of why you are paying more at the pump and what's driving these changes behind the scenes. We'll also show you what to keep an eye on in the days and weeks ahead, so you can stay informed and make the best decisions for your budget and your family. Let's start by looking at the numbers, because they really set the stage for what's happening in the oil market right now. Numbers don't lie. They capture the drama, the excitement, and sometimes the anxiety that comes with big market moves. This week, the data is telling a powerful story of momentum and change. Oil prices are not just inching up, they're surging, and that's sending ripples through the entire energy sector. In fact, oil prices are on track for their biggest weekly increase since June, marking a dramatic turnaround after months of relative stability and even some declines. That's a significant move in a very short amount of time, and it's catching the attention of investors, traders, and even everyday consumers who watch gas prices. There are two main types of oil that people watch closely: Brent crude, which is the global benchmark, and West Texas Intermediate, or WTI, which is the standard in the United States. These two types often move together, but each has its own story and influences. Both Brent and WTI have seen their prices climb to the highest levels since early August, breaking through resistance points that had held for weeks. For the week, both Brent and WTI are set to jump by more than 4%, a remarkable gain in such a short span, especially for a market as large and liquid as oil. A 4% leap in just 1 week is a big deal. It's the kind of move that can impact everything from airline ticket prices to the cost of shipping goods around the world. As of this morning, the price for Brent oil futures was hovering around $69 per barrel, a level not seen in months and a clear sign of renewed strength in the market. Meanwhile, WTI crude was trading at about $65 per barrel, reflecting strong demand and tightening supply in the U.S. market. The upward trend is clear, and it's making everyone in the market a little nervous. When prices move this quickly, it often signals that something fundamental is shifting beneath the surface. The recent surge signals that the balance between oil supply and demand is getting tighter. Inventories are shrinking, and producers are struggling to keep up with the pace of global consumption. It's not just one single thing, but a combination of factors: geopolitical tensions, production cuts, and unexpected demand spikes that have all come together at the same time to push prices higher. Together, these ingredients are creating the price jump we are now experiencing, and the world is watching closely to see what happens next in this high-stakes market. A major reason for the recent spike in oil prices is growing instability in Eastern Europe. Specifically, events in Russia are causing serious concerns about the world's oil supply. Ukrainian drone attacks have targeted key Russian energy facilities. These attacks create a direct physical threat to the flow of oil and gas. The market is reacting to the risk that these attacks could continue or even escalate. Uncertainty is a powerful driver of prices, and right now, there is a lot of uncertainty surrounding Russia. The situation is made even more complicated by the potential for new international sanctions against Moscow. This combination of physical attacks and the threat of political action has put the global energy market on high alert. The fear is that the current supply issues could get much worse before they get better. In response to the attacks, Moscow has announced new rules that limit its exports of fuel. They have put partial curbs on the export of diesel fuel and extended a ban on gasoline exports. These moves are designed to protect Russia's domestic market. These export bans have an immediate effect on the global supply chain. Countries that normally import diesel and gasoline from Russia now have to find those supplies somewhere else. This forces prices for diesel and gasoline to rise, contributing directly to the higher prices we are seeing now. Let's turn our attention back home to the United States, where the story of oil prices is just as dramatic as anywhere else in the world. One of the most important factors influencing oil prices right now is what's happening with our own oil inventories and how quickly they're changing. In recent weeks, the data has shown that we are drawing down more of our stored oil than analysts and industry experts had predicted. This is a clear signal that our immediate supply is getting tighter and that the cushion we rely on for emergencies is shrinking. The American Petroleum Institute, which tracks these numbers closely, recently reported a substantial drop in U.S. crude inventories, much larger than what most people were expecting. No matter what the exact figure is, the trend is unmistakable. We are burning through oil faster than we are able to produce it domestically or bring it in from abroad. When inventories fall more than expected, it's a bullish sign for oil prices, signaling to traders and investors that the market is tighter than they thought. It suggests that demand for oil is not only strong, but possibly even stronger than what the market had anticipated, with more people and businesses needing fuel for transportation, manufacturing, and daily life. This increase in buying activity as traders react to the tightening supply adds even more upward pressure on prices, creating a feedback loop that can drive prices higher still. Remember, the United States is the world's largest consumer of oil, so any changes in our supply and demand patterns have a massive impact, not just here at home, but across the entire global market. The fact that our inventories are falling so quickly is a powerful indicator that the market is currently undersupplied and that there may not be enough oil to meet demand if this trend continues. This domestic supply squeeze, when combined with international risks and uncertainties, creates a very strong case for why oil prices are likely to remain high and possibly even climb further in the near future. We can't have a full conversation about oil prices without talking about OPEC. OPEC stands for the Organization of the Petroleum Exporting Countries. It's a group of some of the world's most powerful oil-producing nations. Together, this group controls a huge portion of the world's oil production. They can choose to cut production to push prices up, or increase production to bring prices down. For a long time, OPEC Plus had been holding back supply. However, earlier this year, some members of the group decided it was time to start bringing some of that supply back. The plan was to gradually add more oil back into the market. However, there's a catch. Experts believe that this level of delivery might not last. The market is beginning to realize that there isn't a lot of spare capacity left. This lack of a safety net makes the market much more vulnerable to price spikes. Another piece of this complex puzzle is the health of our own U.S. economy. A strong economy means that businesses are busy, factories are running, and people are employed. All of this activity requires energy. Recently, we've seen data that shows the U.S. economy is surprisingly resilient. This is good news in many ways, but it does create some uncertainty for the Federal Reserve. The Fed has been trying to keep inflation under control. A very strong economy can sometimes lead to higher inflation. The decisions made by the Federal Reserve matter a great deal. Interest rates affect the cost of borrowing money for everything from a car loan to a business expansion. A strong economy means strong oil demand, which pushes prices up. This robust demand for energy in the US is happening at the very same time that global supplies are being threatened. It's this combination of high demand and risky supply that is creating the perfect recipe for the higher oil prices we're seeing today. Stay informed, and we'll continue to bring you the latest. On top of everything else, we also have new developments in trade policy that could affect the oil market. President Donald Trump has recently announced a new set of tariffs. These new tariffs are aimed at several different products, including a new 25% tariff on imported heavy-duty trucks. This could have a direct impact on the transportation sector, which is a huge consumer of oil. If it becomes more expensive for companies to update their fleets, they might delay buying new, more fuel-efficient trucks. This announcement has also brought back some old worries about global trade tensions. A slower global economy would mean less demand for oil, which would normally push prices down. While the supply risks from Russia and the low inventories in the US are the main drivers of the current price surge, these new tariffs are a wild card. So, let's bring all these different threads together. It's clear that we are in the middle of a significant moment for energy prices. The reason you are seeing higher numbers at the gas pump is not because of one single issue, but because of a powerful combination of factors all happening at once. First, we have major supply risks coming from Russia. At the very same time, right here in the United States, our own oil savings account is shrinking. This combination of shrinking supply and rising demand is the classic recipe for higher prices. Looking ahead, there are a few key things to watch. Keep an eye on the situation in Eastern Europe. We also need to pay close attention to the weekly U.S. inventory reports. For now, the pressure on prices remains high.